Well, come next week, we will see the budget. Budget 2023, probably the last, or rather is the last full budget of this government. What is in store in the budget? Well, one big piece of that puzzle for you, the investor, is the capital gains tax regime in India. Now, let's zoom out a little bit. Let's try and understand what the capital gains tax rates are. Broadly, capital gains tax is in fact, the rates are lower than your general tax rates. Your general tax rates go up almost up to 43% for HNIs, but even 30% for other individuals. But for capital gains tax, broadly, the rates range between 10% to 22% at the very max, even if I were to include surcharge and cess. So why are those rates lower? One possible explanation for this is that to encourage the population to save a little more, of course, and that helps the government. The other piece, of course, is the fact that it encourages the population to invest a little more in assets, and that too in capital generating assets, in assets which appreciate in value and which give a return to investors. So to encourage a sense of saving as well as investment, and to encourage capex within the economy, there is a capital gains tax regime which is put in place. Now let's try and understand India's capital gains tax regime. India, unlike the world, has an extremely difficult and an extremely complicated tax structure, wherein your capital gains taxes are dependent on the asset that you are buying or selling. So real estate will have a very different capital gains tax computation as well as rate versus say a listed equity share, versus say an unlisted equity share, versus say a resident selling a listed or an unlisted equity share, versus a non-resident selling a listed or unlisted equity share. So there are so many permutations and combinations and applications to this capital gains tax regime, which is really what makes it complicated, and that is what the industry is looking to solve for, is looking to simplify for. On top of this, there are another couple of complications and nuances. The listed equity share regime was, the long-term listed equity share regime was virtually tax-free till 2018, from 2004 to 2018. Now they've brought in and they have taxed the listed equity shares, and what they've done is they have created transition provisions for that taxation as well. So they further added to the complication. In 2004, when long-term capital gains tax on listed equity shares was abolished, what they did was they introduced STT, which is securities transaction tax, on both the buy side as well as the sell side. Now they've continued with STT and they've added LTCG, which is long-term capital gains on listed equity shares. So essentially, one needs to streamline some of these regulations and processes. The other piece that we understand is the listed equity share pie of long-term capital gains is 80,000 crore, which is the collection, which is roughly 6 to 7% of the government's direct tax collections, which is quite large as well. So, removing it or doing away with it will be a difficult thing to do. So how do they streamline it? Do they streamline holding periods, which is 1, 2 and 3 years for different types of assets, or do they streamline the tax rates, or do they do both? And at the same time, they mustn't spook the investor. That's going to be of essence, absolute essence for markets, and that's what markets will be looking out for. Both resident as well as non-resident investors will be looking out for how this particular streamlining process may happen. It may happen in a staggered manner over years, but it will be watched out for, and it will be something which is very crucial. Watch out for Budget 2023.
If you like this video, then like, share and subscribe to ET Now.